There's a wealth transfer mechanism that has moved $50 trillion from the middle class to the top 1% over the last 40 years. And right now in 2025, we're entering the final stage of the largest transfer in human history. In 2008, $16 trillion in middle-class wealth disappeared in 18 months. Home equity, retirement accounts, savings, gone. The money didn't vanish. It was transferred. By 2010, the top 1% had recovered all their losses and gained an additional $8 trillion. Within the next 24 months, another $20 trillion will transfer upward as 3 asset bubbles collapse simultaneously. This has happened 4 times since 1980. And here's what should terrify you. Each transfer is larger than the last. The cycles are getting shorter, and the mechanism is now so embedded in the financial system that it's become automated. The siphon is running 24/7, and most people don't even know it exists. This is the story of how wealth systematically flows upward through engineered boom-bust cycles, why the middle class keeps losing wealth despite growing economies, and why the mathematical structure guarantees the next transfer will be the largest in history. And it's happening faster than anyone wants to admit. Before we go through the 4 historical wealth transfers, you need to understand what the siphon actually looks like. Not in textbooks, in practice. The wealth siphon operates through a predictable 5-stage cycle that repeats every 8 to 12 years. Stage 1. Easy money creation. The Federal Reserve drops interest rates to near zero. Money becomes cheap. Credit flows freely. This is presented as economic stimulus to help everyone. In reality, it's the setup. Stage 2. Asset bubble inflation. Cheap money floods into assets, stocks, real estate, bonds. Prices soar. The middle class is encouraged to participate. Don't miss out. Buy now before prices go higher. Everyone's getting rich. Financial media cheerleads the boom. Regular people pile in with their savings, their home equity, their 401(k). Stage 3. Peak euphoria. Assets hit absurd valuations. But the insiders, banks, hedge funds, private equity, the top 1%, start selling. Not publicly, quietly. They're getting out while retail investors are getting in. The smart money exits. The dumb money enters. Stage 4. The crash. Something triggers the collapse. A bank fails. A default happens. A bubble pops. Asset prices crater 30%, 50%, 70%. The middle class, who bought at the top, sees their wealth evaporate. They panic sell at the bottom. They lose their homes. Their retirement accounts are gutted. Their savings disappear. Stage 5. The transfer. While the middle class is selling in panic, the top 1% is buying. They have cash. They waited. Now they acquire assets at 50 cents on the dollar. Real estate, stocks, businesses. The wealth doesn't disappear. It transfers from the middle class to the wealthy. Then the Fed drops rates again, and the cycle starts over. This isn't conspiracy theory. This is documented history. It's happened 4 times in 40 years. Same pattern, same mechanism, same result. Trillions flowing upward each cycle. Let me show you exactly how it works. Let's start with the first modern wealth transfer, the S&L crisis of the late 1980s. After the brutal recession of 1981 to 82, the Federal Reserve dropped interest rates from 20% to 7%. Money became cheap. The government deregulated savings and loan banks, allowing them to make riskier investments. Credit flowed freely into real estate. Between 1983 and 1986, commercial real estate prices soared. Office buildings, shopping malls, apartment complexes, all financed with cheap debt. S&Ls made loans to anyone. Developers built everywhere. The boom was on. By 1986, real estate was in full bubble mode. Buildings were being constructed with no tenants. Loans were made based on inflated appraisals. S&Ls were competing to lend. Whoever offered the most money won. Risk was ignored. The middle class participated through home purchases and small real estate investments. Properties were flipping for quick profits. Everyone was making money. Financial advisors said real estate always goes up. By 1989, S&Ls held $1.1 trillion in assets, much of it in over-leveraged real estate. But the smart money, institutional investors, wealthy developers, was already exiting. They were selling properties to smaller investors, to S&Ls themselves, to anyone who would buy. In 1989, real estate values started falling. Over-leveraged properties couldn't meet debt payments. S&Ls began failing. 747 S&Ls collapsed between 1989 and 1995. The FDIC seized $394 billion in assets. Middle-class depositors lost savings. Small investors who bought real estate at the peak were wiped out. While S&Ls were failing and middle-class investors were losing everything, who was buying? Private equity firms. Wealthy investors. They bought failed properties from the government at 30 to 50 cents on the dollar. The Resolution Trust Corporation liquidated assets, and the smart money acquired prime real estate at massive discounts. Total wealth transferred upward, approximately $500 billion in 1990s dollars, roughly $1.2 trillion today. And here's what people do and understand. The S&L crisis wasn't a random failure. It was an engineered boom-bust cycle. Easy money created the bubble. Deregulation allowed reckless lending. The crash was inevitable. And the wealthy, who caused the crisis through overlending, acquired assets at fire sale prices when it collapsed. The middle class lost. The top 1% gained. Let's jump forward 10 years to the late 1990s. After the S&L crisis, the Fed kept rates low to stimulate the economy. Between 1995 and 1998, interest rates hovered around 5 to 6%. The internet was emerging. Tech companies were going public at astronomical valuations. Money was cheap, and Wall Street directed it into tech stocks. The Nasdaq went parabolic. From 1,200 in 1995 to 5,048 in March 2000, a 321% gain in 5 years. Everyone was investing in tech. Day trading became a profession. Financial media ran nonstop coverage of millionaires made overnight. The middle class piled in. Retirement accounts, college funds, savings, all went into tech stocks. Pets, Com, Webvan, dozens of companies with zero profits trading at billions in market cap. It didn't matter. The internet changes everything. The smart money, venture capitalists, early investors, insiders, was selling to retail investors. By early 2000, tech stocks were 35% of the S&P 500. Valuations were insane. Price-to-earnings ratios in the hundreds. Companies with no revenue trading like they were printing money. Retail investors believed it would go up forever. March 2000. The Nasdaq peaked. Then it collapsed. From 5,048 to 1,114 by October 2002. A 78% crash. $5 trillion in market value evaporated. Middle-class investors saw their retirement accounts cut in half, in thirds. People who had been paper millionaires went back to zero. While retail investors were panic selling, who was buying? Warren Buffett. Private equity firms. Institutional investors. They bought quality companies at crashed valuations. Amazon at $6. Apple at $7. The smart money accumulated while the middle class capitulated. Total wealth transferred. Approximately $5 trillion from retail investors to institutional investors and the wealthy. And here's what people do and understand. The dot-com bubble followed the exact same pattern as the S&L crisis. Easy money. Asset inflation. Media cheerleading. Retail investors buying at the top. Insiders selling. Crash. Transfer. The siphon ran again, larger than before. Let's jump forward to the biggest wealth transfer in modern history, until now. After the dot-com crash, the Fed dropped rates to 1%, the lowest in 50 years. Alan Greenspan said it was necessary to prevent deflation. The real effect, it created the biggest credit bubble in history. With 1% rates, everyone could borrow. Mortgages were practically free. Wall Street created new financial products, subprime loans, Alt-A loans, no-doc loans. Anyone could get a mortgage. The credit flowed into housing. Home prices went parabolic. Las Vegas homes doubled in 2 years. Miami condos tripled. Everyone was flipping houses. HGTV ran shows about getting rich in real estate. The middle class was told housing always goes up. It's the American dream. Buy now or be priced out forever. People bought second homes, investment properties. They refinanced and pulled out equity to buy more. The average American's net worth was their home. Everything was tied to housing. By 2006, housing was 70% of American household wealth. Mortgage debt was $10 trillion. Everyone was leveraged. Everyone believed prices would keep rising. But the smart money, institutional investors, private equity, was already exiting. Blackstone, and others were selling properties quietly. Subprime mortgages started defaulting in 2007. By 2008, the entire financial system was collapsing. Lehman Brothers failed. Bear Stearns failed. AIG failed. The stock market crashed 50%. But worse, housing crashed 40% nationally, 60 to 70% in bubble markets. Middle-class Americans saw their wealth evaporate. $16 trillion in household wealth disappeared between 2007 and 2009. Retirement accounts cut in half. Home equity gone. Millions of foreclosures. The middle class was destroyed. While homeowners were being foreclosed on, who was buying? BlackRock, Blackstone, private equity firms. They raised $100+ billion and bought hundreds of thousands of homes at 40 to 60 cents on the dollar. Single-family rentals became an institutional asset class. The Fed dropped rates to 0% and printed $4 trillion through QE. That money didn't go to foreclosed homeowners. It went to banks and Wall Street, who used it to buy crashed assets. By 2012, the wealthy had recovered all losses and gained trillions more. Total wealth transferred, approximately $16 trillion from the middle class to the top 1%. And here's what people don't understand. 2008 wasn't a failure of the system. It was the system working exactly as designed. Easy money, bubble, crash, transfer, the largest wealth siphon in history. And the middle class, who lost everything, never recovered. Homeownership rates for under 40s dropped from 43% to 37% and never came back. And here's what should keep you awake at night. We're in the fourth cycle right now. The largest wealth transfer in history is being set up as we speak. Stage by stage, let me show you. In 2020, the Fed dropped rates to 0% and printed $5 trillion in 18 months, more than the entire 2008 crisis. Money became free. Credit exploded. This was the setup for the everything bubble. Check. Since 2020, everything went up. Stocks hit all-time highs. Housing up 40%. Crypto went parabolic. Bonds, commodities, even used cars, everything inflated. The middle class was told to invest. Don't fight the Federal. Inflation will eat your savings. Everyone piled in. Retail trading hit records. Meme stocks, NFTs, FOMO everywhere. Meanwhile, the smart money, hedge funds, private equity, insiders, was distributing, selling to retail. Every IPO, every SPAC, every crypto offering, retail bought from insiders. Check. 2021 was peak euphoria. Stocks, real estate, crypto, all at all-time highs simultaneously. The everything bubble. Middle-class wealth on paper was the highest in history. But it was all leverage, all debt, all inflated assets. And the smart money was out. Check. 2022 to 2024, stocks crashed 25%. Crypto crashed 70%. Bonds had their worst year in history. Real estate started falling. But this isn't the big crash yet. This is the warning crash. The real crash, when commercial real estate collapses, when regional banks fail, when the treasury market breaks, that's coming in 2025 to 2027. Check. Within 24 months, 3 crashes converge. CRE, regional banks, treasuries. Assets will crash 40 to 60% across the board. The middle class will panic sell again. And the wealthy, sitting on record cash reserves, $5 trillion in money market funds, will buy everything at fire sale prices. BlackRock is already preparing. Private equity firms have raised record amounts of dry powder, cash waiting to deploy. They're not worried about the crash. They're waiting for it. They know the pattern. They know the transfer is coming. Total wealth that will transfer, $20 to $30 trillion. The largest in history. First stage is complete. Want to go? Check. Since 2020, we've accelerated through every stage faster than any previous cycle. The S&L cycle took 9 years. .com took 7 years. Housing took 8 years. This cycle, from easy money to crash, will take 5 to 7 years. We're in year 5. The crash is imminent. And each cycle, the transfer gets larger. S&L Crisis, $500 billion. .com, $5 trillion. Housing, $16 trillion. This cycle, $20 to $30 trillion. The siphon is accelerating. The wealth flowing upward is increasing exponentially. For times it happened before, each time following the exact same pattern. Easy money, bubble, euphoria, crash, transfer. Each time the middle class lost, and the top 1% gained. Each cycle larger than the last. The pattern says we're next. Maybe this time is different. Maybe the crash won't come. Maybe the transfer can be stopped. But the S&L crisis happened anyway. The dot-com crash happened anyway. The housing collapse happened anyway. Every time, people thought it would be different. Every time, they were wrong. The math says the fifth transfer is coming. The timeline says 12 to 24 months. And history, which has watched wealth flow upward the same way 4 times in 40 years, says the middle class is about to lose again. The siphon is running. The transfer is set up. And this time, it'll be the largest in human history.